And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Environmental, social, and governance. I'm talking ESG. That kind of investing, it remains controversial, with some saying investors are demanding corporations pay more attention to broader social issues. Others are saying corporations should stick solely to earning profits for their shareholders. Joining us to discuss is Vivek Ramaswamy. He's the executive chairman of Strive Asset Management. Arnie Nowak, the head of Systemic Investment Solutions for the Americas at DWS. He runs several ESG funds. And Todd Rosenbluth is the head of research at Verify. Mr. Ramaswamy, thank you very much for joining us. Really appreciate it. You have been very vocal claiming ESG is an example of woke capitalism. Your Strive U.S. Energy ETF, DRLL, that's the symbol, tracks an index of energy stocks which attempt to use proxy voting to influence energy companies. Tell us what kind of engagement you've had with the companies your fund owns, like Exxon and Chevron. Are they listening to your message?
We've already engaged with 10 publicly traded energy companies. I wrote a public letter, a shareholder letter to the board of directors of Chevron, and I was pleased to see the company was engaged in mutual dialogue. I had dinner with the CFO recently in New York City at the request of the CEO, and that's what I think we need more of in the boardroom. More open debate representing a more diverse set of perspectives than we've heard in the boardrooms of these companies over the last several years. Our perspective is that U.S. energy companies should be focused on drilling, on fracking, on doing whatever allows them to be most successful over the long run, without regard to any other political, social, or environmental agenda, leaving politics to the politicians. Now, people on the other side of this ESG debate understandably say that this isn't about politics, this is about maximizing long-run value. You want to know what I say? Great, let's have that debate, because I think what's actually been happening is there were social agendas packed in starting in 2018 and 2019 that have been recharacterized as being in the long-run interests of companies when in fact they are not. And I think that honest debate, I think, is going to be good both for capital markets and for corporate boardrooms. That's what we're hoping to bring to the table.
We're ETF nerds here, and I just want to ask you about the fees of DRLL. The expense ratio is 41 basis points, but you're running essentially a big cap oil fund here. It tracks the largest energy ETF, the XLE, which only charges 10 basis points. If you're a real nerd around this, and we talk about fees all the time, it's a lot to pay for essentially a big cap energy fund. What do you respond to people when people point that out?
Thanks for bringing that up. So we've launched two funds to date. One is DRLL, that is the U.S. Energy ETF. The second is STRV, the Strive 500. That one is 5 basis points, tracking 500 of the largest U.S. publicly traded companies. In fact, in both of the cases, we look to other large firms like BlackRock, like the big three that we're aiming to compete against to set a fee benchmark. And at the time that we launched DRLL, I believe that BlackRock's U.S. Energy Fund, you could look up what that fee is. It's, I think today 39 basis points. I think it was 41 basis points around the time that we filed for our product. But the point is here for investors, the key differentiation that Strive wanted to bring to the market was not stock selection. These are, after all, index funds tracking just an underlying index. You're right, passive asset management, but bringing an actively engaged voice and vote to the table, both through proxy voting as well as through shareholder engagement. You take the public letters that I wrote to the boards of Chevron, of Apple, of Disney. That might be the kind of thing that you see from historically activist funds. Well, this is a passively managed fund, but taking an active approach to shareholder engagement. And one is 41 basis points, the other is 5 basis points, and you can take a look at where BlackRock is across the board. That's kind of one of the things we looked at as well.
Well, that's a fair point. His point here is this is competitive with ESG products out there, and what you're paying for is the active engagement. That's essentially, Vivek is not disagreeing that it essentially is a large cap oil fund.
But he's choosing BlackRock as the villain in this case. He's not choosing State Street that has 10 basis points for its exposure. He's choosing BlackRock because, in his opinion, BlackRock is doing something contrary to what the shareholders should be doing. That's his opinion for that. Investors are going to make that decision. But I would note that the iShares U.S. Energy ETF saw significant inflows within the past month, even though this product has come to market. So again, investors have choices, but IYE is outgaining DRLL.
Well, it helps that oil has stabilized. There is a fundamental story here around energy that certainly makes a lot of sense.